club.
Okay, thank you very much, guys, for coming in and having me over at UCL. It's a great opportunity, and thank you for not skipping the guest lecture. They might not be as academic as you're used to, but at least they give a glance of what's going on in the real world. And when I studied, I personally found them very useful when you really understand what's going on outside of academia, how the startup world works. It's you can network with me to maybe later find a job in the Web3 space. Yes, quick fun fact. Actually, I was a UCL student myself back in the day at the chemistry department, but I never graduated for personal reasons. And at that time, that was 2017, I tried with my friends from economics to start a crypto club. So there wasn't any initiatives or a course like that you're experiencing. So that means bravo to your professors and to university for being so flexible and forward-looking with the things that actually going on in the world and that matter, that attract attention. Yet before there was nothing. So we collected over 100 signatures just coming to random people in the canteen. We had to use the word Bitcoin. So we're like, do you know what is Bitcoin? And would you like to know more? You're like, yeah, I've heard of it. Please sign here. We're starting a new club. I don't know the fate of that club because I left, but the kind of my path led me straight into my job at the tech company, which was later one of the largest ICOs back in the day. If you've heard about this different era of 2017, a big boom, and just like with any booms, nothing good often happens. So I would not name that company, but I'm grateful to them because it then eventually led me to 1inch, and I was the second person in the team who was responsible for all global partnerships. So I'm with the company for nearly 5 years now, and yeah, well, soon I'll be off to my maternity leave, but I spent nearly 8 years in the blockchain world, and I could definitely say it's been an amazing journey where you could look at some of the innovations that's happening, pitch it to some of the largest institutions and banks, your new creations. And what's really important is that because you're making financial transactions more efficient, faster, secure, they're really interested and they want to work with you. So the small kind of job at the startup kind of led me to having calls with the big banks like HSBC and so on, because they were so keen on what is this new technology. So for you, it's an amazing opportunity to kind of pursue in the space if you're interested in that. So yes, I'm doing global partnerships at 1inch. Currently, it is the largest DEX aggregator in the space. That means we have liquidity that we combine from different DEXs. Currently, it's over 300 plus liquidity sources that are combined into one protocol. We search for the best rate and we give the user the best kind of rate to swap. This is the flagship product of 1inch. This is kind of how 1inch got famous in some way. Obviously, now it's a much bigger company with lots of different products. And for today's presentation, we're going to look at kind of the bigger picture of like traditional finance, where we are, the challenges that current institutions experience, and some of the technology innovations that we at the company have developed to address those challenges and to make the world of finance better today. So I stand here. And it's amazing that we're a small group today, so we could make this quite interactive and with questions and some in the middle discussions if I think of some good questions. Usually I don't, but let's see. So the market sizes. Look at where we are in traditional finance market. We have 123 trillion global equity market cap with 318 billion in daily Nasdaq trading volume. That's huge. Now compare that to crypto, 3.4 trillion crypto market cap, 110 daily centralized exchanges trading volume. And now the segment where I'm working is only 120 billion in TVL, total value locked. This number goes up and down some months depending on the hype and the industry cycle. But really, this value is so small, it's like 1 out of 1,000 fraction compared to traditional finance market, and could really be compared to some TVL of a large European bank. As the whole industry, yeah, and 15 billion daily DEX trading volume. So with that, I wanted to demonstrate to you the huge potential of decentralized finance, because in the end of the day, I'm a personal believer that it will overtake some of the current technologies that we're using when it comes to like traditional banks and trading. Another perspective is if we compare like crypto adoption versus internet. So really where we are today in crypto could be compared in around like 1995 to 2000, where we were in the internet in terms of adoption. But the projected growth is exponential. I like to say that crypto today looks like the internet, yeah, in like 90s, with lots of fragmented systems, clunk interfaces that scare the regular user. But it is what we're working on, what you could be working on as the new generation to optimize the future of finance. A quick glance and just a comparison between Web 2 and Web 3. Obviously, DeFi is all about Web 3 technology. Web 2 was about user-generated content and platforms. The real difference is the ownership that Web 3 offers. Before, as you know, platforms owned all of your data, and now is the era where you claim the right to the data back. So yeah, Web3 is definitely about transparency, ownership, and trust. And those are fundamental concepts that surround the technology and its current applications. A definition, if we were to put in words, decentralized finance, a blockchain-based system that automates financial transactions through smart contracts, eliminating the need for intermediates. I think the key factor here is the technology that powers it all. So smart contracts and like the core fundamentals is that we are eliminating the third party and trusting the technology instead of somebody we don't know. Now, why do you think DeFi being so tiny compared to the global market generates a lot of excitement? It's an open question. Is it purely hype, or is it more of a fundamental thing that you think? Yeah. Like why DeFi being so small generates a lot of excitement? Is it because of the hype, like excitement, or one? Yeah.
I'd say it's because something is small. It's returns
Mhm.
So I guess in traditional finance, market cap of things are really high, and in DeFi, kind of like specific startups or employees it's still small on cap, so there's a potential like multipliers.
Okay, so you think more around like profiting maybe in the space. That's why it's exciting. Anyone is excited by like, let's say the foundations, the grounds of technology and how it optimizes the finance, making it better. But let's talk about it. Good point. Actually, I got into crypto in 2017 for the ICO hype as well. So yes.
Something that they don't want the government to know, like the private, um, like Silk Road, like most of this, because people on Silk Road, they're like not to purchase the vehicles. So like, so blockchain is like a really foundation for the Silk Road to exist, and that's how it got popularized. And then later on, it was like, oh, there are more use cases, like people start to make it more legal, and then governments want to use it differently. They recognize there are other benefits of that too as well.
Exactly. Well, this is about accessibility, like the first point you mentioned. Well, for me, like spending 8 years in the space, it's way more, it's easier to set up like my Web3 wallet, like MetaMask, than to open a bank account. Really, DeFi is super accessible. That's anyone in the room, like me, you today, no matter where you're coming from, like your background, your nationality, given that we live in a multicultural world where sometimes we face certain restrictions just because our country of origin, and then we're no longer able to interact with the regular financial system. Well, DeFi solves that. And as people in London or like Europe or US, you might not really like feel the need for that accessibility, but if you were coming from outside of these countries and would know how the system is so fragile, that yeah, DeFi would be a solution here. It is also composable. We call it financial Lego. So for you guys as the computer scientists, you can think of that as open APIs, which you could combine together to build different products, swaps, staking, money markets. So it's really composable. And there's a nice demonstration at the, there's a company called Zerion, and basically just shows what you could do. So check them out if you are interested. Yeah, like once again, we're done with smart contracts. There is no third party. We are trusting the technology, which is transparent, auditable. The code is clear. There's no legal ambiguous language that comes with those like banks and clearing houses that in the regular traditional finance would process all of our transactions. Here, like I'm personally a big truster into the technology. There is no, they don't have like a view or anything. But yeah, you see how DeFi is creating a shorter and more efficient chain. So yeah. Also, it's non-custodian. So that means essentially you're becoming your own bank, and you're no longer needed to transfer your assets to somebody that you don't know, who could then potentially freeze your account, go bankrupt. many things could happen. And once again, especially this is relevant for countries with a less of a stable financial systems. And so this new technology helps to solve for that as well. Now a little bit where it led us, like I just described all of these advantages. Obviously, it did not go unnoticed, and 1inch as a company is currently these numbers. So we've achieved over 705 billion in trading volume, with 25 million active users that are using the protocol. Actually, it's the number of unique wallets that interacted with the protocol, because we don't track the user directly, but the marketing likes to put users instead. 66% aggregator market share. 1inch was the first aggregator out there by combining the sources from Uniswap, Balancer, and Kyber at the hackathon in 2019. So it still remains as one of the top aggregators for now. And peak daily volume went up to 5.25 billion. Usually, we also have a lot of peaks when different centralized exchanges crash. So when FTX crashed, or some other exchanges, usually people are more reluctant towards DeFi technologies. A little bit about the algorithm of 1inch routing. So I've explained to you that we search the root through multiple liquidity sources, from DEXs to, I will also demonstrate you to some private liquidity sources, but also the pathfinder that powers the swap. In one single transaction, it is able to route through connector tokens to achieve the best rate. So here you see the swap from Ethereum, I think that's Dodge, some other dog coin. In one single transaction, like you could take a little bit, let's say, liquidity from Sushi Swap, then you could route to DAI, to Tether, to Dodge, because sometimes it's more efficient to go through those connector tokens for your rate instead of swapping like ETH to this doggy coin directly. So these are like also some things for you to consider. The technology is super smart, and you could really make it do magic. Another part of the liquidity landscape of 1inch comes in the private form. We call those private market makers that are directly integrated into the protocol, and then they supply liquidity. So they create an API which contains two things: price levels and the volumes that they're ready to sell. And a worker would kind of ping their API every 500 milliseconds for the pairs that they're trading, get the quotes, synchronize the quotes with all other liquidity sources, and if those are competitive enough, they would be included in the user trade and the pass. Therefore, once again, optimizing the rate. And in exchange, those market makers would receive a huge trading flow, for like all the retail users that are using 1inch as a platform. So actually, this is part of where I do my partnerships as well. We work with a lot of B2B clients. There's a lot of them in London. So companies like Cumberland, Galaxy Digital, Wintermute are all, like, let's say, typical examples of London-based, specifically liquidity providers. And we're working with them to like power the system and make the swap rates even more efficient. So you see all these like already big liquidity providers, hedge funds are participating into like the current flow because there is demand and they get an additional volume exchange, which they could use to arbitrage or to like whatever trading strategies they're performing. And so this leads us to the institutional world. And on this slide, I've actually collected some of the real headlines. You can Google them just 1 second. From 2021 to 2022. And I wanted to demonstrate that during those years, there was a huge kind of FOMO that institutions were experiencing because of this new technologies, and they wanted to get in the space. Maybe before we go into that, I'll take your question.
Yeah, so I wanted to ask, like, you were saying that there are a lot of liquidity fund in London as well as other countries. So what does a liquidity fund do, and like how does it make you get better rates or something?
Yeah, the liquidity fund, usually they are like either hedge funds or trading firms. So their goal obviously is to get profit on trading. And your question again, there was.
So do they have like a volume, and like they make money off trading basically?
Yeah.
Oh, okay.
Well, here they get a kind of a flow, right? So 1inch is a popular platform, and like they're using that flow to then later hedge into different sources, like own liquidity, centralized exchanges, and so on and so forth. So they're using kind of this flow to then arbitrage elsewhere. And that's why it's a profitable model for them. We charge them also for taking out volumes out of 1inch, but they need to be competitive because obviously here, if you are, this is a typical, if you've heard of RFQ integrations or like request for quote integration, and they need to be competitive to other kind of DEX pools that are out there. And it's getting like harder and harder, but yeah, it's a model that exists. Yeah, and London is a great place to build those connections as well outside of your studies. And so just like look at some of these headlines. Deutsche Bank aims to launch crypto custody service. Citigroup also considers custody and payments for stables and crypto ETFs. Morgan Stanley wants to add Bitcoin to 12 of its funds. Blah, 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 blah. All these institutions were releasing a lot of press releases and media activity into 2021 and 2022. That was the year of where everyone in the space would talk about institutional adoption and how crypto, it's, yeah, being integrated into the banks and so on. Well, let's look if that really happened. In my view, not so much, but we made some progress. Obviously, for institutions, like all the benefits that I've mentioned before, it's an opportunity, right? It's an opportunity to make the technology better, to access new markets, and offer these services to the clients, to reduce costs in all of their operations, and so on. But at the same time, there are challenges, and the challenges are, well, quite big. I looked at part of your course, and I think you'll be looking into some, let's say, relevant DeFi regulation as of today, not DeFi, overall blockchain regulation. But it's definitely the challenge that's so big, and it prevents probably 90% from participating or at least experimenting with the technology. So before I tell you like what did we do at 1inch to address those challenges and to introduce at least some more of a regulated technology, we call it the regulated DeFi. I'd like to quickly tell you that like DeFi itself still not perfect, and there's multiple limitations, including MEV attacks, which I'm gonna go demonstrate on the next slide, and complicated user experience, where if you don't have master from computer science and just doing philosophy, it might be hard for you to understand why your transaction is sandwiched. So here is a big DeFi problem. It comes in the form of maximal extractable value. In our local language, we call these sandwich attacks, which are possible on the blockchain. So to initiate this attack, a malicious bot creates two transactions, one before the user kind of buys, before the trade, and one following after, and kind of creates a sandwich, as you see. But the problem is the attacker is able to benefit from these transactions. Therefore, in 2022, over 100.5 billion was lost due to these attacks. And actually, I think it's crazy that nearly 10% of all transactions that happen on chain are subject to these MEV attacks. So what did we do to address those challenges with 1inch technology? So this is kind of the solution that came as the market reaction to first like institutional demand and also some of the big MEV problems that were out there. We introduced the 1inch intent swap. Actually, you guys probably the first audience looking at a rebranded brand after all the people that are currently in Singapore for token 2049. Yeah, 1inch was rebranded to this black and white text. No longer a fancy unicorn company. And like some of the names are also now named differently. Before, this whole solution was called 1inch Fusion. From yesterday, it's officially 1inch intent swap. And basically, it's a limit order on chain that is broadcasted to market makers. We call them resolvers, who are verified. So let's say 10 different trading parties undergo QIC and AML with us directly at 1inch, and then they're able to be listed like in 1inch intent swap to fill the orders. So this was part of the solution where we wanted to demonstrate institutions that they're no longer facing some gray liquidity or unknown counterparties, because they're now facing like a verified pool of professional traders, resolvers who are filling those orders. Because it is a limit order on chain, it is no longer subject to MEV attacks, and we've also made it gasless. So another big problem in DeFi was that for every single transaction that you send, that you want to swap asset A to asset B, you had to pay gas. And at times when the crypto is booming, the gas prices are super high. And so that's prevented a lot of users from their participation. And this 1-inch intense swap is completely gasless because, well, in some way, gas would be included in the worst price that you get for your assets. But the verified resolvers, so professional trading parties, are settling the gas fees, so you don't need to hold any specific token for your trade. Also these verified resolvers. You see here your question about like arbitrage and their own liquidity. They source liquidity from multiple sources, from centralized crypto exchanges to other decentralized exchanges to their own liquidity if they just have capital sitting in their pockets. They use all of that to fill the trades. And yeah, because of that, you have access to unlimited market liquidity. And once again, a really good rate, because here it's not just one resolver who operates, but a pool of 10 who are competing with each other to fill your order at the best possible price. So yeah, it's a slight alternative to AMMs and order book based DEXs, this 1-inch intense swap. It looks maybe a bit confusing, but it's actually a really cool solution. And then later on, like particularly in my role, we use that to go to some of the larger institutions and TradFi entities to tell them that, hey guys, now you could let your customers access DeFi through this particular technology. And actually it was a success. So there's a couple of mostly Swiss banks that are currently experimenting on this in the sandbox. And I really hope that we'll see more public announcements going forward. Yeah, I think this is just a marketing slide where it demonstrates that once again, those resolvers are sourcing the liquidity from across the market, from SEXs to DEXs to own liquidity and so on. Where do we stand today? Like today. As I said, some of the major banks are building on DeFi infrastructure, so they are interested to use the technology. They're a bit slow, but it is what it is. Bitcoin ETFs hold now 3% of total supply. JP Morgan did offer crypto-backed loans, and we have, yeah, this 3 trillion of total crypto market cap, which is okay. Any questions up to this point? Because right now we're gonna go into some problems that were not exactly solved really well. And I think it's an opportunity for you guys if you decide to pursue in the space. Like these are super relevant. And this is what everyone's trying to address. And it comes in the form of the overall DeFi fragmentation. Because you probably know that we have all these different chains. Some of you probably know, like memes on Solana, BNB chain, Base, Avalanche, Polygon. There's a growing number of them. Some are more popular than the rest. But the problem is that they don't talk to each other. So it's like, I like to make an example that all of these are like big European capital cities, like London, Hong Kong, Paris. where the people and activities like never match or interact. So it's like we haven't invented planes before, and the people are not mixing. The same is happening on chain with all these different chains. And what's worse is that they're competing with each other to kind of steal the users. And the even bigger scale problem is the whole crypto fragmentation. So DeFi is only one part. Then you have Bitcoin with its own like Bitcoin network, Litecoin, Sui, and so on. So all of these are standing quite far apart. And although it seems that they're kind of working together, in reality, they're not. And so we have 2.5 trillion to 3 trillion of market cap, completely fragmented into different parts. So you can use that as an inspiration on how to combine this. And I will give you an example of how we at the company are approaching this. And once again, this is only like kind of the solution that our engineers have created, but is far from perfect and may not be as popular today. But it's based on hashed time lock contracts. And we basically combined intent-based and atomic swaps together into this wonderfully confusing diagram. But we can go step by step. The combination of our solution where we introduced cross-chain swaps. So in order to bring this liquidity together, we introduced the cross-chain atomic swaps. And it's a combination between some off-chain calls, which is not perfect, and on-chain transactions. It happens in a couple of phases. So phase 1, phase 2, phase 3. First, the user creates an intent to make a swap, a transaction. So they have one asset on source chain and a different asset on the destination chain. They check the rate at 1 inch. Like once they're happy, they click send. And then we have a Dutch auction that starts. Dutch auction is basically, you probably know, and the price goes down with time. And then this order is broadcasted to, once again, resolvers. So the system is powered once again by private liquidity providers. And the transaction is broadcasted to resolvers. Once they find it profitable based on the Dutch auction price, they lock in the rates and phase 2 starts. So phase 2 would include a liquidity provider creating 2 escrow contracts, one on the source chain with the user funds and one on the destination with their own funds, including some security deposit on the source chain. I'll tell you later why it's needed. And after that, we have a time lock phase. So it's different chain to chain, and the resolver would eventually determine the time. But it is needed to reach a finality. So if you're familiar with the like blockchain, sometimes reorganization of the blocks could happen. And there's a famous like 51% attacks that are example of that. So there's still a lot of kind of ambiguous big security questions around how to best combine all this liquidity. Like this is what we are proposing. So once the finality has been reached, the relayer would tell the user to share the secret. The secret is used to unlock both escrows. The relayer tells the users to share the secret, and the secret is then broadcasted to the resolvers, which then use to withdraw the maker tokens to the user and their own tokens from the source chain, effectively completing the swap. Now, this system only really works and is efficient with 2 or more resolvers, obviously competing, because it could happen that a resolver forgets to do one of the actions, and then it is no longer the transaction would fail, and they would lose their security deposit. So they put some security deposit on their source chain in order for it to serve as an incentive for other resolver to complete all the actions for the resolver who failed or did part of his job. So this is, what 1inch introduced to the market as a way to solve for the previous problems that I've mentioned before. And the time locks obviously are super central and crucial here. You could, one of the papers I shared was around us kind of introducing this whole, it's called Fusion Plus, now it's called an intent-based cross-chain. Yeah, they created a long name for that. But check out that white paper that was written by engineers, because I feel it's quite fascinating, all these steps, and obviously you're probably building algorithms and step up to step. But this solution, once again, is far from perfect, and still all these problems kind of remain, but at least we introduced this. It's getting popularity. At 1inch, we support 13 different networks. In the name of these, if you recognize some of those logos, like Polygon, Optimism, Avalanche, Solana. But as you saw, there's a huge number of networks available, still not talking to each other. It is also maybe protected by design because the order is directly matched to the resolver. These swaps are also gasless, as they are in the regular intent swap. Once again, because it's powered by market makers, they source liquidity from all across the market. Recently, we've had an addition of Solana. It is more difficult to introduce cross-chain solutions to non-EVM chains. So it was a big step into kind of bridging between Solana ecosystems and EVMs. But there's a lot more. Bitcoin is completely unsolved. A glance at the Dutch auction. So both cross-chain intents and regular intents are powered by the Dutch auction mechanism. And these are super efficient when it comes to user experience, because the order price starts slightly above the market. And it goes down with time, but because the liquidity providers are competing to fulfill this order, the user eventually could get a much better price. And so this is an actual demonstration of the swap that was happening of 12.8 million USDT to wrapped ETH at 1inch, and the user gained 209K in surplus. Plus, the Dutch auction is adjusted to the gas price. So it's efficient for both the user and the liquidity executor. Then compared to the standard option price curve. So what did we cover? We covered intent-based cross chains and a little summary of how it looks like today at 1inch. These are atomic swaps, so there is no bridge risks, no wrapped assets, direct peer-to-peer with cryptographic guarantees. Intent resolution, you experience a direct outcome of your transaction. Unified liquidity, yeah, true capital efficiency, somewhat. Gasless experience, so for the retail, like once again, we are building for the users globally. So we optimize their experience by not telling them to pay for the gas. Why does it matter at all what we're doing? And this is just the 1inch impact that we were able to measure in economic terms. It was 1.2 billion that was saved in gas fees. 1.5% average price improvement, once again, because I showed you how the Dutch auction works. Good transaction success rate. And with that, we're processing quite a large volumes on a daily basis. Now, why does it matter in the global terms? So these are projections. And yeah, you could use that to pitch your new technology. To lower the transaction cost by 80%, 5 to 10x faster settlement time, higher increase in available liquidity, and less over slippage. So these are just some of the key economic impacts of putting all the liquidity together and making different ecosystems talk to each other eventually. Yeah.
Is it gonna work for only the major coin? For example, like if I want to swap a meme coin to Ethereum, something like that, it's like gonna help also.
Yeah. There's no small coins or big coins. Essentially, it's all the coins that are available out there. So all coins, memes on Solana could be swapped to some really small market cap coin on Avalanche chain in one transaction. Yeah.
Big better sleep.
Yeah. Better price optimization. You dropped the exactly. Yeah. So that's why DeFi allows you to do anything and reach those long tail assets, we call them, that might not be available on centralized venues because they're not too big, or they don't pay centralized exchanges money to be listed there. So we eliminating those problems. And this is our vision, but I also want to pass this vision onto you. What is important? What do you want to achieve? We want to have a unified liquidity layer. So we want to transform all these fragmented pools into a signal efficient market. And as you mentioned, coins is just the beginning. The potential, I have a slide that could be, not just crypto to crypto. Chain abstraction. So make blockchain infrastructure invisible to end users. They don't need to understand what exactly is going on and make it too hard. And focus on user outcomes, not the technical processes. This is called intent-based architecture. And once again, where we are today. So if you ask a regular crypto user, these are probably all the problems that they would tell you. You need to navigate between different UIs, worry about certain securities, wait for confirmations, lose money because of MEVs. You need to switch networks manually. So it's really like, yeah, internet of the 90s. How do we see it tomorrow? One interface that's connecting all these ecosystems, all chains. The users don't need to think about more technical aspects like gas cost. There's no security concerns. There's instant execution of transactions, guaranteed settlement. There's no MEV risk, and so on. Now, when would it happen? In 2024, it was all about infrastructure and tooling. 2025, we did nothing. No, it's a continuation of infrastructure and tooling development. But next year is hopefully the year when we will see a more efficient ecosystem integration. This is probably way too optimistic, but the year after that, mass adoption of crypto. But really, it's so interesting and cool what you could do with this technology. And it goes, as I said, far beyond just crypto. Like crypto is just one segment of assets that this technology could be applied to. But eventually, and I'm not saying essentially, eventually, because I know it would happen, the future of trading would be also regular currencies, securities, real world assets, and they're also more and more of them are coming on chain today. So you would be able to go from your meme coin to some security or RWA or currency of invest into some, yeah, currency that outside of pound, dollar, and euro. And all transparent, trustless, and efficient. So we are hiring. And 1inch as an organization, it's definitely been an amazing career for the past 5 years for myself personally. We are fully decentralized. We are following the concepts of the DeFi technology. So you could be in London, you could be in, I'm thinking some other city outside Paris and Hong Kong that I've named. You could be in Chile, in Latin America, and still contribute to this amazing technology. Currently, we are 200 people spread across the globe. It's a very well-funded project with 200 million raised by the top VCs. If you are bored of remote work, just like I am, you could be working from the office in Dubai. And yeah, we definitely have a lot of different positions, both technical and non-technical, since I'm going to maternity soon in the company. So you could use that QR code if you want to like scan for some open positions at the company. And it's definitely like, this industry is also really nice because of the freedom it creates. You're not part of the, like, you probably guys want to work for some investment bank like BlackRock or JP Morgan. But they're all very structured and they don't give you a lot of space for creativity. You usually join as an analyst and then take 10 years to progress to a senior analyst. And with the like faster moving technology than traditional finance, you could really build what you want and become who you want, essentially. And if you want to do that, you can reach out to me. This is my Telegram. I think I made it private, not in the right time, but I can connect with you after this lecture, and also some more 1-inch links on social media. And with that, thank you very much for being here and enjoying this lecture.
Thank you very much. Do we have any questions?
Do you feel inspired at least? Yes.
So when you do cross-chain swaps, how do you guys deal with like slippage? Because I assume it's an issue when it slip during cross-chain swaps.
Well, the price when the phase 2 starts, the price is fixed. So the Dutch auction, when the resolver finds a rate profitable, he kind of locks in the price and then makes 2 escrows on source chain and the destination chain. The rate is not amazing, but yeah, it's something for you to think about and maybe be part of our hackathon. Yes.
I want to ask, like, how do you make the transaction gas price?
The liquidity providers, so resolvers, they include the gas price in the rate that you'll get. So although you don't need to hold the tokens, and somewhat your transactions are less favorable, usually, but essentially you're facing a professional executor. So let's say you're a retailer swapping your $100, facing like a huge institution which trades like 500 mil per day, and then they cover your transaction cost. So it's all because it's powered by professional traders.
So, like, the cost is there, but it is divided or distributed over a large volume.
Yeah, like somebody else pays it for you. So resolvers pay it for you. Yeah. Not you, which once again for you makes the experience more, better. You don't need gas token, some chain. You just click, swap and send, and then some other party would cover the cost. Yeah.
Any other question? Maybe I can ask a question. So, can you comment a bit on how 1inch has evolved from 2019, where I guess it was a completely on-chain aggregator, to what has become today in an intent-based solution? What have been the steps across the process, and maybe to help them understand a bit more on the cross-chain swaps, what will be the super naive approach for doing a cross-chain swap, and what you're gonna achieve now with the intent-based solution?
So how did we evolve from being just like settling on-chain transactions to intent-based? Well, everything is based on demand, just like with any solution. You need to keep to the market. Like the first intent-based where I demonstrated, it was called Fusion before regular Fusion. It was a way to bring like institutional swaps into the space by letting them know who is the counterparty, demonstrating that their resolvers have passed ML QICs and they're the ones filling the swaps. So it's not like some unverified pools that are bubbling around the space. And then cross-chain is something quite new to our company. and it's still gaining traction. Compared to all other products, it's probably like the least popular right now, because once again there were other bridges and other protocols that were first in this and were building quite a long time. But at one end, we see the problems, like real problems, like here this is broken, we need to fix it. Let's do a hackathon to fix it. So I think like overall at the company, this has been the approach of building and introducing and shipping new products to the market when we see demand both retail and institutional. Our teams come together and then they build solutions to address it. Yeah.
Do you have any do you have a question? Do you have any statistics or any pen and paper numbers about what percentage is in the same chain and what percentage is cross-chain swaps nowadays?
First is what percentage
is in the same chain, like Ethereum swaps, and what percentage is cross-chain?
Yes, we do. Maybe I could send some links over to Professor Tami. You could share with the students, but there's this really great analytics website called June Analytics, and it's dashboards that compare like certain transactions. We have our own one for internal purposes. Still, most of the activity, like particularly with us, is not happening cross-chain. So cross-chain, can we look at the June?
Yeah,
Here. So June Analytics 1inch. Yeah.
right.
That's right.
Just loading. Yeah. So just like a comparison, like our regular aggregator, all-time volume, yeah, it's this. Okay, here is a breakdown of like the products. So aggregation protocol is the regular kind of swap, the first initial solution that I've demonstrated. Fusion mode is the intent based, and Fusion Plus mode is the cross-chain intent. So let's see, like we can look at 24 hours maybe. So like yeah, 330 mil on the regular aggregation protocol. So that's purely EVMs. Now Fusion is less, so Fusion is this intent-based 73.6, so 330 mil to 73 mil on the intent, and now on the intent-based cross-chain, 6 mil.
I guess there are growing markets at the moment. Right?
Yeah, they're growing
And
market,
there is more competition to what means.
but you see it's like less than 10% of. And here you could see like the most like popular chains in 24 hours, like ETH to Arbitrum, BNB to Arbitrum, how much was processed. Those bubbles as well.
Yep.
Yeah, so like these dashboards are very open and you could use that data to build your own stuff or to, yeah, I mean, see what's going on.
Any other questions?
In this lecture, in my version of the things I was hearing for the first time. So like as a new person who is just introduced to blockchain, so what should we learn to like get a hang of it? As like apart from the coursework, as we talked about there.
Okay, good point. I didn't know that. Well, the fun part is that there's not like much official materials on it. So yeah, obviously you have the scores, which is great. Like before, people didn't even have the scores. But you see how popular and how much in demand this new technology is. So at least for now, I demonstrated you that this niche is super interesting. It's growing. And then you could use that to facilitate your own research. Really, that's mostly how it's done because the space is indeed very new, although you would learn like some step-by-step fundamentals. Yeah, self-research is irreplaceable when it comes to innovation. And that's the beauty of it, because yeah, not only like you're researching what's new, but you're able to contribute to, like, once you have a little bit of a bigger picture, you would see that, okay, maybe I could bring that aspect of traditional finance and put this technology on top of it. And this is the new innovation that I'm going to create. So, yeah. Self research. Actually, when I was at UCL, it was such a disappointment statement to me when they told me that the university will no longer look like school. And I was like, why? I really enjoyed it. Just a very clear path. But yeah, especially like university and then innovation and finance and technology is all about pure interest of your own research. But then I could definitely tell you it's very much rewarded and it is in great demand by a lot of the companies.
Do we have any other questions?
We can continue with this.
Then let's thank Valeriya.
Thank you.
We have some refreshment at the back, so we can still talk with Valerie about any further questions that work. We'll continue after a 10
Yeah,
minutes.
we will take a 15 minutes break. There are some refreshments, so help yourself. Thank you.
Nice. Who created this course?
Okay, we started last year.
So it's new.
Yeah, because we wanted to